Friends, the topic of today's podcast is figuring out the right advice. This is something that markets always wonder. Most of us need advice to emerging economic context. And when the context is going to change so rapidly as it has happened in 2020, the advice must be sharp, timely, and swift. Which means that the traditional way of giving advice, which is just ask people to buy a few funds and hold it for the next 5-10 years, is not going to work. It is exactly in a similar context that I ventured into the advisory space, and this was in the year 2009. You had the global financial crisis. I had nothing to do with mutual funds at that time. I was a pure equity investor and a research analyst. So, out of curiosity, when I started looking at the mutual fund space and what people were owning heavily, I found that most of the people were owning the wrong funds. Then that curiosity led me to understand what is the right advice that these people can receive, because I clearly knew that they were owning the wrong funds. So that search led us on to what were the right funds. Interestingly, what we thought of as the right funds then was nowhere in the favored list of the industry. So when we started some trial conversations with investors who were heavily into mutual funds to understand what they were owning, educate them as to why those funds will not succeed, and try to make them think afresh, there was huge resistance. In this cycle, when I see the same resistance, I kind of got used to it. It's like deja vu, something we already seen before. When we had those conversations then, there was hardly any pressure on us because we hadn't started a business. We didn't want to become advisors. We just wanted to understand what was happening in the mutual fund industry. So we took that experiment to the next stage and tried to ask people, why do you want to stick to the same funds, which are being constructed to a different economic context? In 2008, funds were constructed to a infra boom. That was the underlying mood of the market. Everybody preferred to have funds which were infra heavy. In 2020, most funds are financial heavy, and most portfolios are also small and mid-cap heavy. So these two are kind of a compact. I see very serious parallels between 2009 and now, and I see very serious risks to your investing as well. Cutting a long story short, what we did then was we tried to tell people informally and try to understand, and then it didn't meet with much success in 2009 or 10. But after the entry law was abolished, we thought, why don't we become advisors and try to formally do it? And that's how the ithought journey began, and it has progressed to where it is. The COVID-19 crisis is a bad crisis to have as a society. But as an advisor, it is something that tests our ability to respond, our ability to react, our ability to have been proactive earlier. All these things are being tested. So in that sense, though this is a very painful phase for all of us, it is also a phase where we are able to validate what we have done in these 10 years. And it is from that validation that I'm going to put a few points which I think is good advice. Firstly, I believe that merely sitting on financial heavy portfolios is not going to work. So mutual funds which are very heavy in financials are not going to deliver. You are going to see a prolonged phase of grinding where it will appear that they are regaining and then they will again lose. So we have seen this in the last cycle and it's going to repeat. Similarly, investors who have constructed a portfolio of mutual funds with very aggressive mutual fund schemes are going to have a rough time. The reasons are purely macro, purely economic, and purely structural. So, you really need advice to change what you have done between 2018 and February 1, 2020 into what will work between February 2, 2020 and whenever it happens over the next 3 to 4 years. So it's a new journey that you have to make now. And remarkably, most of us have invested a lot of money prior to February 1, 2020. So there has to be a walk back, taking stock, and then moving ahead. The industry, the mutual funds, the narrative, everything tells you that it's just a pause and you're going to just keep walking ahead. There's no walk back, there's no taking stock in that schema. And that's where I see a structural flaw in how mutual fund investing is being approached now. For the last several years, people have been saying that, oh, it's all about fees, it's all about commissions, it's all about income. And I see this more coming from the investor side. Let me be very frank. Investing and advice is not about this. To get the best ideas, you need to work and you need to be ahead and you need to stay ahead. So an advisor has to always keep his clients 2 steps ahead of the pack. Now, that will also be painful when it takes time for the pack to catch up with you. It's happening. It will keep happening. But if you are 2 steps behind the pack, I am afraid that you have no hope. Today's mutual fund investing is many steps behind what it should be to succeed in the post-COVID era. So, wherever you're looking for advice, you need to find an advisor who will first walk you back a few steps from what you have done in the past few years, who will take stock clearly, and then gradually walk you forward into the future. Essentially, you need the right mix of conservatism and dynamism. The reason we are still in this business is because between 2011 and 2014, we were able to clearly prove what this meant to a small subset of people. That subset of people have experienced this approach. I'm sure there are others also who are very much capable of doing what we're doing, but we can talk for ourselves and we would like to say that this is the way to do it. You need to manage risks far better now than ever before. Allowing mere time averaging and giving time in the market for the wrong kinds of funds will not deliver results. It's like traveling on the wrong road for a long time. If you do that, what are the consequences? You still need to come back, step back, take stock, and again travel in a new path. So the advisor who stops you today on the wrong path is the guy who can really deliver. An advisor who already gave you advice may also come forward and tell you, sorry, that was wrong, we need to change. But if nothing is told to you, if you are just told that ठीक है, सब ठीक हो जाएगा, over time everything will come back. See, the NAVs went down in March and April, they've all come back now. That is not advice. That is not walking back. That is not taking stock, and that is not preparing you for the future. So as an investor, finding the right advice now is to understand what is the quality of this advice that you're getting, how much is it future ready, how much is it willing to accept past mistakes, how much is it calibrated to move from the past mistakes to what will work in the future, and how much is it committed to finding that path for you. So that is the essence of advice, and that is what made a person like me take an interest in mutual fund advisory. In doing so, I was also able to identify winning qualities in fund managers, winning portfolio strategies, reading patterns which will succeed, identifying investment patterns where we are taking some risk but not grave risk, and the reward for those risks which we take are significant. Investing in mutual funds is far more complicated than investing in direct equities. This has been my learning of the last decade, and I continue to take great interest in mutual fund research and investing purely for this reason, that it is far more challenging. Because you are not the person who constructs the portfolio. There are hundreds of fund managers who believe in their competence and who construct different varieties of portfolios, and you need to pick a small subset of great portfolios from a vast field. And then you need to track that subset. You need to identify which will do well, and you need to ensure that your investors, those who value your advice, are actively invested in that subset and stay invested till they win. This is far more complicated than building a simple portfolio of 10, 12 equity stocks and holding. But the kind of outcomes it can create has been quite thrilling, greatly satisfying, and always challenging. That is what has made me look at this area, and that's what makes me constantly look at this area along with a vast team of people who work with me to identify what is good advice, what is that advice that will bring you out of your weak portfolios of 2020 to create those winning portfolios of the future. Thank you very much for watching this podcast. Feel free to reach out to us. We will be happy to extend this conversation into your portfolio, identifying specifics for you and taking you on that path. Thank you very much.